So floating rate funds typically invest in U.S. corporate floating rate loans. These are typically the senior secured loans that companies issue for a variety of purposes. Could be leverage buyouts, M&A transactions generate a lot of loan origination. And again, typically these are the first lien senior secured part of a company's capital structure. So it's typically similar to having a mortgage on the company's house, so to speak. And then in addition to that, obviously the coupon structure is LIBOR based, so it's floating rate. You know, closed-end funds are interesting in that they can be typically volatile day to day. So we always recommend that investors that allocate to any closed-end fund have a long time horizon. Having said that, right now, most closed-end floating rate funds are trading right around their net asset value. One of the most interesting times to buy closed-end funds is when they're at a deep discount. Today, they're really not. However, the fact that they trade around the NAV is really reflective of a couple things. Number one is fundamentals are generally pretty good within U.S. credit. That's a reason that they're trading near net asset value. And investors are worried about rising interest rates, so the demand for floating rate products has been very strong. So unfortunately, it's hard to buy floating rate closed-end funds at a deep discount when there's a lot of reasons to buy them, such as there are today. Floating rate corporate loans can be illiquid. They typically trade over the counter, and during periods of supply-demand imbalance, their prices can move substantially day to day. Closed-end funds are actually an ideal home for floating rate loans. Closed-end funds don't have daily inflows and outflows, so portfolio managers can make investment decisions based purely on what they want to be buying and what they want to be selling versus worried about inflows and outflows. So closed-end funds are a great way to own floating rate loans. Well, one of the bigger picture trends that we've seen in floating rate loans is bigger companies issuing floating rate loans. We've been sub-advising loan portfolios for Nuveen going back to 2001. And back in those days, the companies that would issue floating rate loans were in many cases mom and pop companies. If you look at those same funds today and the holdings and the issuers that are issuing these loans, these are large transactions, bigger companies, in some cases, you know, really household names. So that's really led to a different risk dynamic within the market. And one other thing I would mention is, in terms of issuance, there's not a lot of energy issuance within the loan market like you may have within the high yield market. Energy is a big concern for a lot of investors, and so it's important to kind of take into consideration that you're not getting a lot of energy exposure if you allocate to a floating rate portfolio typically. Floating rate loans do a few things for investors. Number one is they generate income without taking a lot of duration risk. A lot of investors right now are worried about the impact of rising rates on long duration, traditional fixed income portfolios. And loans are a way to generate or supplement that income without taking a long duration bet. As you mentioned, they also can be a great hedge on traditional fixed income portfolios, just a way to spread your money out amongst different income producing assets. And last but not least, I always like to mention that floating rate loans, even though they are a fixed income asset, actually tend to correlate positively with equities. So for people that are looking to take advantage of a growing U.S. economy, but are maybe a little bit weary of the volatility that comes with traditional equity investments, floating rate loans are a way to get kind of defensive equity exposure with having a little bit less volatility and more income. Last thing I would say is that fundamentals within the floating rate market really are good. The reality is that companies continue to not only grow top line, but also things like leverage has come down. Really credit fundamentals remain pretty benign right now, and there's not a lot of debt that matures in the loan market for the next year and a half or so. So we really feel like the coming year in the loan market presents a pretty benign backdrop for people to be allocating to this asset class.